Hi, I'm Max Keiser, and this is the Keiser Report. You know, the universe is a very big place surrounding a very large black hole. The global economy is a very large economy surrounding a very large black financial hole. Let's get the latest from Stacy Herbert.
Max, that financial hole, of course, is caused by debt.
Debt, glorious debt.
And debt is in the headlines today. Debt as a nation destroyer and debt as a weapon. Now they hate Goldman in China, too.
Uh-oh.
The opening lines of an article in the China Youth Daily, a state-owned newspaper. Many people believe Goldman Sachs, which goes around the Chinese market slurping gold and sucking silver, may have, using all kinds of deals, created even bigger losses for Chinese companies' investors than it did with its fraudulent actions in the U.S.
Wow, so China's just getting hip to the fact that wherever Goldman goes, financial fraud follows. Wasn't there some old Confucius saying, like, he who does business with Goldman loses his shirt? No, I think that was a fortune cookie I had at the Steak and Brew on Wall Street one day.
Well, the article also refers to Goldman as, quote, a black hand that played little tricks carefully designed to gamble with Chinese enterprises. The article, however, made few specific accusations of wrongdoing by the bank.
Confucius say, little Goldman tricks turn into big Goldman tricks.
So other articles in China have also been critical of Goldman over the past few months, including criticism of Goldman for designing and selling oil hedging contracts to state-owned Chinese companies that then lost billions of dollars when oil prices plunged, contrary to Goldman analyst predictions in 2008 and 2009. So recall, Max, that Goldman was predicting $200 oil. In fact, I think I remember seeing a $250 per barrel oil prediction from them. Well, at the same time, going to Chinese state airlines and selling them oil hedges.
Goldman, China, you want to all be capitalists. Let me explain something to you about capitalism. If the Wall Street broker is recommending one thing, do the opposite. I can't believe there are still suckers out there that actually buy Wall Street research. Oh, China.
There's a sucker born every minute. That's the Confucius
say, don't listen to Goldman Sachs research. You lose your shirt. But I'm surprised they accuse Goldman of slurping silver and eating gold. Remember Goldman and J.P. Morgan are in the suppression game of keeping the price of silver artificially low and keeping the price of gold artificially low. The only defense that the people in China have against Goldman Sachs racketeering is to buy as much gold as possible to decapitalize those folks down on Wall Street that are trying to destroy your economy.
Well, the good thing about the statement, slurping gold and sucking silver, is that when we have a new victim, like China, apparently, we get new sort of phrases. It's a good introduction to cultures around the world.
Yes, people in different cultures around the world have figured out their local variants on one basic phrase. Goldman Sachs is stealing my money.
Well, speaking of debt and the cost of bailing out all these fraudulent debts around the world, U.S.'s $13 trillion debt poised to overtake GDP, chart of the day.
Yeah. That's right. It's the chart of the day. You see, the debt in America is skyrocketing, and soon it'll be more than the GDP, or the gross domestic product, which, of course, much of it is dedicated to paying the interest on the debt. David Cameron over there in the UK just figured out that something like 10 cents of every dollar that they're earning over there in the UK goes to debt service. And he's saying, no, we got to emulate Canada in 1994 and put in draconian austerity measures. And I would imagine that Canada will be held up as the model economy around the world as the UK, the Eurozone, and other countries figure out, you know what, we got to get rid of all this Goldman Sachs created debt if we're ever going to survive.
Well, the chart I referred to in the headline is a chart showing the U.S. GDP and the U.S. debt. And you see that they're narrowing, they're getting closer, and the IMF data says that the U.S. debt will pass GDP by 2012. Now, Bill Gross, manager of PIMCO, which is the largest bond trader in the world, they say that U.S. economic growth won't be enough to support the borrowings if real interest rates were ever to go up instead of down.
Oh, well, that's true, but you see, this is my part of my combined, my unified inflation-deflation theory, is that Wall Street creates trillions in fiat currency, and to protect the purchasing power of their own bogus fiat currency issuance, they stage the occasional default, whether it's a Greek default. The Greek economy has been sacrificed on the altar of Goldman's Christmas bonuses. Same thing with Latvia, same thing with Iceland. And soon it'll come to America, so Americans soon will have to engage in austerity measures in order to keep the purchasing power of all the phony money that's being created on Wall Street for their Christmas bonuses. Remember, it's not Christmas unless Wall Street gets at least a $150 bonus.
Well, of course, the austerity measures, what always happens is that you see the selling off of state-owned assets, privatization, that is often handled by the likes of Goldman Sachs and J.P. Morgan that crashed the economy. And this is what you see in China as well, or in Greece, which is going through austerity measures. Who's handling all the privatizations? Goldman Sachs.
Well, I told the Greek people weeks ago when they were trying to decide whether to elect me to be president of Greece. I pointed out the fact that all of their assets would be privatized and sold off by Goldman, the very company that were creating the financial arson to begin with, are now going to benefit on both the arson and selling of the charcoal as the result of their arson, which are your state, your privately owned state assets, which will now be owned by the oligarchs.
Well, at the moment, and regarding this U.S. debt to GDP ratio, Dan Fuss of Loomis Sales Bond Fund is also quoted in this Bloomberg article, and he says that he's sold all of his U.S. Treasuries, and the reason why is, quote, the incremental borrower of funds in the U.S. capital markets is rapidly becoming the U.S. Treasury. Do you really want to buy the debt of the biggest issuer?
Right, so the U.S. government bond dog is eating its own bond vomit.
Well, you can put it that way, Confucius, Max.
Confucius say, he who eats own bonds after issuance is like dog eating own vomit.
So there's another way to look at this debt. So the IMF data says that the U.S. debt will not surpass GDP until 2012. Over here on Jesse's Cafe Americain site, you can see that U.S. total government debt reaches 130% of GDP.
Right now!
Exactly.
Right now! Explain. Tell the people. Tell the people. Tell the people.
Well, his numbers include state and local debts and GSE debts, Fannie Mae and Freddie Mac. So you could look at the chart, which is actually from contraryinvestor.com, and it shows that the debt is now at 130% of GDP.
That's Barney Frank's slush fund. Fannie Mae and Freddie Mac. $5 trillion.
Exactly.
Which, of course, is the obligation of the American taxpayer. They will have to assume all that interest cost and debt liability. But during the bull market, when things were going up, they were told that they would not have to assume those liabilities while the CEO of these companies pay themselves huge multi-billion-dollar bonuses and fees. But now that they were caught engaged in essentially a pyramid scheme and a Ponzi scheme, they're just shuffling all that liability onto the American taxpayer. And, of course, America then shuffles all that liability onto the world economy vis-a-vis the U.S. dollar. The U.S. dollar is a world reserve currency. It's the mechanism that allows America to take trillions of bad debt put into the market by corrupt bankers on Wall Street and corrupt politicians like Barney Frank into the world economy. That's why the world should dump the U.S. dollar as their reserve currency.
So this takes me to the next headline. Banks bilking taxpayers by refusing to buy back toxic loans. So during the housing boom, these giant banks would issue mortgages and then be able to sell them on to Fannie Mae and Freddie Mac. These two.
The slush fund.
Well, it turns out they are a slush fund. But so this kept the whole boom going bigger and faster and harder. But to protect themselves from getting piles of garbage loans, Fannie Mae and Freddie Mac required lenders or loan servicers to sign contracts requiring those firms to repurchase loans that did not meet certain standards relating to borrower income, job status, or assets. Loans that were extended fraudulently or deemed to have been predatory or also candidates for buybacks. So Freddie Mac in particular, but Fannie Mae as well, but they don't report their data, have been trying to sell back these loans, which turned out to be fraudulent or overstated or misstated incomes. And the banks, lo and behold, surprise, surprise, are refusing to buy them back.
That's right, because it's a racket.
They're not honoring their contract.
They're not honoring their contracts, and they've got a racket going, which includes the rating agencies, which we now know Moody's is part of a racket. The Wall Street research, like Goldman's research, is part of the racket. The investment banks, the politicians who deregulate these markets to allow the racket, and Ben Bernanke, who keeps interest rates artificially low to enable the borrowers and the speculators and the racket. They're racketeers, just like Al Capone was a racketeer. These guys are financial racketeers. You got to use anti-racketeering laws to put them all in jail. RICO, baby. Hit the RICO button. Obama, listen to me, babe. Listen to me, babe. Obama. Obama. RICO! RICO, baby! Okay? That's all I'm saying. Geithner, Summers, Bernanke, all into jail.
Well, the top 3 lenders or loan servicers doing business with Freddie Mac are, according to this article, J.P. Morgan Chase, Bank of America, or Wells Fargo.
RICO. Talking about
and on this,
RICO.
I just want to end on a very funny quote from Kurt Eggert, a professor at the Chapman University School of Law. Banks have been unwilling to mark all the bad loans they have and mortgage securities they hold to their true values because that would require a loss. But this is about banks trying to avoid losses and having taxpayers absorb them. So by, of course, not marking to market their loans, they have an argument that the loan is worth all it's worth on the books of Fannie Mae and Freddie Mac. It wasn't fraudulent.
Confucius say, true value of bonds is not 100 cents on the dollar, but really 2 cents on dollar. Lose shirt. Well, Stacy Herbert, thanks again so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more. Stay there.
Every month, we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Welcome back to the Keiser Report. And it's time to go to Taipei, Taiwan to talk with Vincent Fernando. Vincent is a chartered financial analyst, and he's also a writer at businessinsider.com. Vincent, welcome to the show.
Yeah, thank you, Max.
Vincent Fernando, we're seeing turmoil, market turmoil all over the world. The week started off with the Nikkei plunging 4% on Monday. The euro continues to tumble. Chinese property prices and volume of transactions are collapsing. What is your assessment of the situation, and where is the most dangerous market to be right now?
Well, I think right now, obviously, the two major concerns, I would say, the situation sort of shifted away from the U.S. in terms of concerns. The two major concerns are obviously Europe and financial contagion, and China and, can they manage a soft landing rather than a hard landing? And so some people are worried maybe that the drop in property prices might have been a little sharper than what the government intended. In terms of, where are the most dangerous parts of the market right now, I think it's actually in international markets. Actually stock markets in the BRICS nations, things like that. The reason why is because that's where really most of the investor optimism has really gone in the last few years. If you actually look at the U.S. stock market, if you look at fund flow data, we've actually seen negative fund flows in 2008, 2009, and actually year to date 2010. In fact, in May we saw some of the worst fund flows since Lehman collapse in 2008. So really, there isn't a lot of sort of churn being wiped out in the U.S. It's not hype being wiped out. It's actually a deepening and an exacerbation of investors' bearishness in the U.S. that we've just seen played out. But in international markets, we've actually seen a lot of positive fund flows for quite a while. So basically, when things get bad, there's a lot more room for money to flee out of international stocks than there are in U.S. stocks.
All right, let's change gears slightly. In the financial global crisis, is it caused by too much debt or by mark-to-market accounting and capital requirements? If regulators, for example, removed Tier 1 capital requirements, would banks start lending again and the economy recover?
No, I really think it's caused by too much debt. I think blaming accounting is kind of like to imagine that the intangible things we make up in our accounting are sort of the core of the fundamentals, but actually the fundamentals are just when you take on too much debt. So I think the core problem is that we've had too much debt. If you loosen the regulations, would banks lend more? I think actually probably not. I think what's happening right now is we're seeing deleveraging across the world, and it's a natural reaction to having too much debt. And it's actually what we really want to see, because, the whole problem was that, especially, for example, U.S. banks, is that too much debt was taken on. And so now I think deleveraging is a healthy adjustment process, and it's because companies still aren't sure where the holes in their balance sheets might pop up. And so I think it's you have to let that process happen naturally, where banks are more comfortable with their own balance sheets before they're going to start lending. It's not just about loosening accounting standards.
All right, so just to fill folks in on what the Tier 1 capital requirements are about. In other words, banks around the world, they have to have a certain amount of reserves on their balance sheet. As everyone knows, we live in a world of fractional banking where banks can lend out much more than they actually have on deposit. This Tier 1 number refers to high-quality assets that are known to be liquid, that they're known to have some value. And so is anyone arguing at this point? I know I asked you the question, is the problem Tier 1 capital requirements, should they be reduced? But is anyone arguing that they should be reduced? Is that a meme? Is that a thought out there that people actually think that part of the problem is to make banks even more technically insolvent?
The pressure for banks to lend isn't really so much coming from that angle. It's more, there's just this odd meme, I would say also, especially in the U.S., where people are sort of blaming the banks for not lending more right now. It's kind of ironic because, we just came out of a situation where people said that the banks kind of went wild. But now you have this idea that the banks aren't supporting the recovery by sort of becoming more responsible. So I think that's really where the main pressure is from.
Okay, so banks are not lending, and it's not a factor of their balance sheet and their reserve requirement. It's the fact that they are trying to pay down the debt, which would seem like a prudent thing to do. The Keynesians are saying, no, lend more to try to fake it till you make it. Paul Krugman, of course, at the New York Times, he thinks you should fake it till you make it. He's a Keynesian. And the Europeans are saying, no, we believe in honest accounting. We're more of an Austrian school. And so who's right in this debate?
In the end, I think you want to take the route more of the Austrian school, where you want to be, rather than trying to flood the economy with easy money, I think you want to be really cutting spending. And so I'm a big fan of austerity. Now we have news out of the UK that the Conservatives might actually be pushing a pretty powerful plan to implement austerity there. They're looking at what Canada did in 1994, and Canada was able to get out of a debt crisis within just a few years. So I think it's a pretty good historical precedent for the use of austerity. So I'm definitely a fan there. But I should say I have to be a bit nuanced. I'm not sort of this hardcore. I think there, I don't take an extreme view there, because I think there is some argument for a degree of stimulus, because there will be some substantial pain within the society. You could have, again, it might be actually impossible to push through extreme austerity because of the let's say, riots that could erupt in a country. So you need some degree of stimulus to kind of keep the situation from boiling over as you deliver the austerity. So I think I lean towards austerity, but you have to take a slightly balanced view towards it.
Well, yeah, but it's impossible, because you can't just have a little stimulus. It's either austerity or stimulus. And in Canada, in 1994, when they imposed austerity, they had a society that was really more socially coherent, the social cohesion index was such that there wouldn't be rioting. In the U.S., because so much has been promised through entitlement programs, you don't have the social cohesion, so you're going to have rioting. So why can't we just be honest and say there's going to be rioting, but the risk is that we completely lose our sovereignty?
Again, I'm a fan. I'm a fan for the spending cuts. It is a bit trickier, like I said, when you have long-term entitlements, because those are much harder to remove rather than sort of programs that are just every day. I would still say, though, the problem is that in the way politics work, I mean, if you're too extreme in austerity, when you try to implement austerity, if politics really boil over, I mean, the party that is trying to push austerity can get knocked out, and then you have let's say, a less responsible party coming in to sort of satisfy people's anger, and that could sort of backfire. So I think you should take a sort of a nuanced approach where you're trying to sort of sugarcoat, the medicine a bit.
Right. Well, I'm not sure nuance is possible in America, which is a country that thrives on blatant and bold kind of miscarriages of logic. But let's move on. Regarding China, you have a headline on BusinessInsider.com. Quote, wage inflation officially comes to China as Foxconn doubles salaries after a rash of suicides. Okay, so wage inflation in China. Of course, China's been the factory of the world, and the countries, especially in the U.S., and Walmart has benefited by these low slave wages. Now they've got higher wages coming. Tell us a little bit more about this. Is this good? Is this bad? Tell us more. There's
actually been wage inflation happening for a while in China, especially in the region near Hong Kong. Long term, it has to happen. And I think what we're seeing here, the doubling of salaries is actually obviously a pretty extreme hike. I think what we're starting to see is that China is losing its sort of endless pool of cheap labor. It actually has a lot of people in other parts of China, but where a lot of the manufacturing is situated near the coast, there's actually many times a shortage of labor, and wages have been rising. And I guess as we see from the suicides, maybe also people's aspirations are rising as well, so they won't accept what they used to. And I think the implications of this are that you're going to have other economies which used to be called China plus one options, such as Vietnam, Thailand, Indonesia, etc. They will start to be more competitive versus China, because they used to have a problem where their wages were still higher than China. Now they'll be more in an even playing field. Obviously, in the U.S., it's also good news for anyone, for labor costs, relative labor costs in the U.S., because China won't be as competitive over time, especially with the yuan hike coming, in the next few years. The Chinese currency and the American currency are pegged, so there's a lot of subtleties in analyzing both these two economies as they kind of go around this tango of trying to grow and use each other as leverage to finance all kinds of internal growth, but also export growth. So let's move on to an economy that doesn't have a currency tied to the dollar, the Eurozone. You recently wrote that, quote, there are three signs that Europe's enormous bailout has already failed. This is kind of like the big kahuna in the big global stage now. You're saying it already has failed. The three big signs, tell us more. The three signs are basically the euro-dollar rate, which is now below 1.20, and there's also the credit default swap spreads for periphery nations in Europe, such as Greece. And finally, you have the ECB deposits, which represent banks basically not willing to put money with their peers, even on a short-term basis, and they're willing to put money with the ECB, accepting a lower rate of interest just because they've lost trust in their peers. Now, all three of these indicators are basically near record highs again. Whereas basically pre-bailout, it was very well documented. Everyone was sort of going crazy about how credit default spreads were soaring for nations, like Greece, Spain, etc. And then the euro was losing value. And then what happened was they had the giant bailout, nearly $1 trillion, at least announced towards the problem. And all of a sudden, this credit default spreads fell again, as if looking like things were better. The euro got some strength, etc. But now, all these metrics have spiked back up to almost just about as bad as they were pre-bailout. So that's why I'm saying that these three indicators, they're now looking like the bailout only sort of only mollified markets' concerns for a month. That's about it. And now it's back to just like we were before, but the bailout's already been announced. So my question is, what's next? What does the Eurozone have left to sort of throw at the problem? Now that they've already used the big guns. All right, time for the lightning round of questions. For these three questions, a simple yes or no will do. Will the euro survive? No.
Will Germany be better off exiting the Eurozone and reestablishing the Deutschmark?
Yes.
David Cameron's austerity measures announced for the UK, good or bad?
Oh, good. Yes.
Finally, Vincent, nowhere in the world seems to be immune from the collapse of the global debt bubble. What do you see over the next couple of years? Is this deflation the biggest problem?
Deflation is the most likely path going forward. That's because we've just come out of a period of substantial job losses and substantial underutilization capacity in the U.S. and Europe, etc. I think the way it plays out is I think the most likely scenario is that Europe sort of stagnates into an ugly mess, but doesn't, we don't have financial contagion into the rest of the world. I think China will slow down, but will avoid the hard landing. And that's when I think, and then the U.S. will eke out meager GDP growth and will still have high employment. But I think that's when we'll realize that we actually the world doesn't need Europe for growth. It never needed it. It just needs China, BRICS economies, and the U.S. And as long as those are going forward, I think we're going to grind forward. And I think even for markets and such, it's going to be bumpy, but I think the most likely scenario is that we're grinding upwards.
Right. Well, Europe, basically, the only thing we need it for are the shoes from Milan. Okay, so Vincent Fernando, thanks so much for being on the Keiser Report.
Yeah, thank you very much.
And that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Vincent Fernando of BusinessInsider.com. If you want to send me an email, please do so at keiserreport@rttv.ru or follow me on Twitter, Max Keiser. That's Keiser. Until next time, this is Max Keiser saying bye, y'all.